Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Exelixis Inc. Annual Report. Exelixis Inc. is a leading oncology company that specializes in the discovery, development, and commercialization of innovative medicines for difficult-to-treat cancers in the United States. The company's portfolio includes several key products and services. One of its flagship products is CABOMETYX tablets, which are used to treat patients with advanced renal cell carcinoma who have received prior anti-angiogenic therapy. Another notable product is COMETRIQ capsules, designed for the treatment of progressive and metastatic medullary thyroid cancer. Additionally, Exelixis offers COTLLIC, a combination regimen for specific forms of advanced melanoma. The company also has a range of other products in its pipeline, including MINNEBRO, an oral nonsteroidal selective blocker of the mineralocorticoid receptor used to treat hypertension in Japan. Furthermore, Exelixis is developing several novel compounds, such as zanzalintinib, XL309, XB10, and XL495, which target various cancer-related pathways. In addition to its product portfolio, Exelixis has established research collaborations and license agreements with several prominent pharmaceutical companies, including Ipsen Pharma SAS, Takeda Pharmaceutical Company Limited, F. Hoffmann La Roche Limited, and others. These partnerships enable the company to leverage expertise and resources in order to advance its pipeline of innovative cancer therapies. Overall, Exelixis Inc. is a pioneering oncology company that is dedicated to developing and commercializing groundbreaking medicines for patients with difficult-to-treat cancers. Exelixis Inc.'s stock price surge, a year of growth and advancements in the past year. Exelixis Inc. EXCL has experienced a remarkable 31.04% increase in its stock price from February 2025 to February 2026. This significant growth can be attributed to several key factors that have contributed to the company's success. One of the primary drivers of Exelixis' stock price increase is its strong financial performance. The company reported substantial year-over-year growth in both revenue and earnings for fiscal year 2025, with total revenues reaching $2.32 billion and GAAP net income rising to $782.6 million. The U.S. cabozantinib franchise was a major contributor to this success, generating $2.12 billion in net product revenues. In addition to its financial performance, Exelixis has also made significant advancements in its drug pipeline. In March 2025, the FDA approved CABOMETYX for 2 new indications in neuroendocrine tumors, contributing over $100 million to CABOMETYX net revenue in 2025. Furthermore, the company's new drug application, NDA, for zanzalintinib was accepted by the FDA in February 2026, setting a target action date of December 3, 2026. Exelixis has also been actively engaging in share repurchase programs, which have helped boost shareholder value. The company repurchased approximately 24.1 million shares for $954.1 million at an average price of $39.61 per share in 2025, and authorized an additional $750 million share repurchase plan in October 2025. Lastly, positive analyst coverage has also contributed to Exelixis' stock price increase. Several financial analysts issued buy and strong buy ratings for the company's stock, with price targets ranging from $44 to $52. These factors combined have driven Exelixis' stock price up by over 31% in the past year, making it a notable performer in the market. Exelixis Inc. maintains a market capitalization of $12 billion, broadly in line with the industry peer group. Exelixis Inc. trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 5.33 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for a company can be attributed to several key factors. Commercial milestones, such as the $150 million in license revenues from Ipsen in 2024, have been significant contributors to revenue growth. Regulatory milestone payments, including the $4.3 million payment from Ipsen in 2025, have also played a crucial role. Additionally, royalty fees earned by Royalty Pharma have shown growth, with an increase from $68 million in 2023 to $86.5 million in 2025. Milestone payments have been another important driver of revenue growth, with the company achieving $138 million as of December 31, 2025. Furthermore, royalty revenues on net sales of cabozantinib in Japan have provided a significant source of income, with tiered royalties ranging from 15% to 30%. These factors have contributed to the company's overall revenue growth. On the other hand, there are also potential decline drivers that need to be considered. A decrease in collaboration services revenues due to a retrospective catch-up adjustment under Topic 606 has been a significant factor contributing to revenue decline. Additionally, upfront payments and milestone payments related to research collaborations and in licensing arrangements have decreased from $173 million in 2023 to $25.7 million in 2025. Patent expiration is also a potential threat to the company's revenue growth, as it may lead to a decrease in revenues due to loss of exclusivity. Furthermore, competition from Handa Oncology's product may also impact the company's revenue growth. Overall, while commercial milestones and regulatory milestone payments have been key drivers of revenue growth, these decline drivers need to be carefully managed to ensure sustained revenue growth. The net income of the company underwent significant changes between 2023 and 2025. Initially, it increased by 151% from $207,765,000 in 2023 to $521,267,000 in 2024. This trend continued with a further increase of 50% from $521,267,000 in 2024 to $782,570,000 in 2025. However, there was a brief decrease of -10% from $77,023,000 to $69,015,000 in 2025. The profit margins also experienced an increase due to the significant rise in net income compared to a relatively small decrease in provision for income taxes. The effective tax rate decreased by -29.1% from 23.5% to 16.9%. As a result, the net income margin rose from 11.4% in 2023 to 24% in 2024 and further increased to 33.8% in 2025. This indicates that the company's profitability improved over the period due to better tax management and higher revenue. The company is indeed generating positive operating cash flow. This can be seen through various financial statements and reports that confirm the trend of increasing net cash provided by operating activities over the years. On page 73, it is stated that in 2025, the company generated $884,267 in net cash provided by operating activities, which is a significant increase from $699,971 in 2024. This indicates a positive shift in the company's financial performance. Furthermore, on page 80 and page 89, it is reported that the operating cash flow for 2025 was $1,143,289,000 and $1,234 million respectively, both of which are net cash provided by operating activities. These figures confirm that the company is generating a substantial amount of positive cash flow from its operations. Additionally, on page 122, it is explicitly stated that the operating cash flow is positive, reiterating the company's ability to generate sufficient cash from its core business activities. Overall, these financial reports demonstrate that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone some changes over the past year. In terms of debt level, there has been a decrease in both absolute and relative terms. According to page 108, the total debt decreased by $240,049, or 15%, from 2024 to 2025. Similarly, on page 80, it is mentioned that the total liabilities decreased from $703,487 in 2024 to $683,104 in 2025. However, when it comes to interest expenses, there has been a significant change. On page 109, it is noted that interest expenses/losses increased from -$2,167,000 in 2024 to -$28,000 in 2025. This indicates a substantial increase in interest expenses over the past year. Overall, while the debt level has decreased, the interest expenses have seen a notable rise. The performance of various segments and regions in the market has been a subject of interest for many stakeholders. In terms of segments, it is clear that CABOMETYX has been a standout performer, outshining its counterpart COMETRIQ. While CABOMETYX's success can be attributed to several factors, including its innovative approach and effective marketing strategies, COMETRIQ's poor performance may be due to various reasons such as lack of market penetration or inadequate product offerings. Moving on to the regional analysis, it is evident that the U.S. has been a strong performer in the market. The region's favorable business environment, coupled with a large customer base, has contributed significantly to the success of companies operating there. On the other hand, Europe and Japan have struggled to keep pace with the U.S., exhibiting poor performance in terms of sales and revenue growth. This disparity can be attributed to various factors, such as regulatory hurdles, cultural differences, or economic conditions specific to these regions. Management is optimistic about the company's outlook, citing sufficient cash to fund operations and contractual obligations. The company plans to continue investing in research and development through capital expenditures and acquisitions. Management believes that leased facilities will meet current and near-term needs. In terms of strategy, the company is advancing its product pipeline portfolio across various indications, with a lead clinical asset under review by the FDA for certain forms of colorectal cancer. They are also innovating next-generation medicines and regimens at the forefront of cancer care. Financially, management anticipates a reduction in product revenues due to Medicaid Drug Rebate Program, MDP, rebate liabilities. However, they do not believe this will have a significant impact on liquidity in the near term. The company's revenue recognition policy is based on Topic 606, revenues from contracts with customers. Overall, management's outlook and strategy are focused on investing in research and development while managing risks and maintaining sufficient cash to fund operations. The company has made several significant moves in terms of acquisitions. On page 54, it is announced that an in-licensed product candidate will be acquired, although the specific details are not provided. Additionally, a strategic acquisition is also mentioned on the same page, but again, no further information is given about this transaction. In contrast to its acquisition efforts, the company has made no divestitures throughout the document. This suggests that it is focusing on expanding its portfolio through new acquisitions rather than shedding existing assets. The company has made significant investments in its shareholders through share buybacks. According to the extracted summary, a total of 30.2 million shares have been repurchased by the company. This move demonstrates the company's commitment to returning value to its investors. The authorized share buybacks program is set to continue over the next few years, with multiple tranches of up to $500 million and $750 million allocated for future purchases. The fact that shares have indeed been repurchased, totaling $1,159.7 million in aggregate purchase price, confirms the company's intention to utilize this program. It is worth noting that there is no mention of dividend payments in the provided text, suggesting that share buybacks are currently the primary means by which the company is returning value to its shareholders. Supply chain disruption concerns abound. The pharmaceutical industry is facing significant supply chain disruption risks. One major concern is the impact of tariffs on imported goods, which can lead to uncertainty and instability in the broader market. Additionally, retaliatory tariffs imposed by other countries can further exacerbate these issues. Another area of concern is the reliability of research and in-licensing partners. If they fail to comply with agreements or experience financial difficulties, it can prevent them from fulfilling their obligations. Furthermore, acquisitions may not honor existing research commitments, and laws, regulations, or practices imposed by foreign countries can hinder scientific research or product development. The third-party contract manufacturing sector is also vulnerable to disruptions. Operational delays due to lack of capacity or resources, facility closures, and global events such as conflicts, tariffs, trade wars, and economic instability can all impact the supply chain. These risks highlight the need for companies to carefully manage their partnerships and be prepared for potential disruptions in the pharmaceutical industry's complex supply chain. That concludes the financial summary for Exelixis Inc. Feel free to comment below, and I will be happy to answer them when possible.